Joining us now, Victoria Green from G Squared Private Wealth and Phil Camporeale from JPMorgan Asset Management. Great to see you both. Phil, why all this chop? Is this just the typical post-Fed, everybody trying to figure out which way things are going?
Yeah, so the uncertainty is really high right now. So I think it's kind of ironic that on the 3-year anniversary, you know, I love dates, March 23rd of 2020, Fed comes out and says, we're going to buy corporate bonds. They basically saved capital markets back then. 3 years later, people are like, they don't know what they're doing, right? Should they be going? Should they be cutting? One of the things that's overlooked here, John, is that we think at the end of the day, they are really close to the end of their tightening cycle. That's the bigger signal through the noise. It's not if they go 25. It's where are they in relation to their terminal rate. So we think that they go one more time and stay there. Too premature to price in easing, though. So we're not at that point yet. And bonds, which we just lamented over last year as multi-asset investors because bonds had their worst year ever. The relationship between stocks and bonds, if you look up in the dictionary, you see the last 2 weeks. You do not see last year. So the bonds are really helping us right now. And people are paralyzed in cash. They don't know what to do. The opportunity cost is greater in cash because bonds have been up 3% in the last 2 weeks. Right? It takes you a long time to get 3%, even at these cash levels. So these are all the conversations that we're having. But the signal through the noise is that the Fed is almost done, and they're just leaving their options open, as they should as central bankers. Okay,
well, Victoria, Phil says that the Fed is just about done with its tightening cycle, but maybe the banks are just starting theirs. You say that you're, I think you said, a cautious bull. What does that mean, right, when we might be at the beginning of a cycle where banks are tightening credit, slowing down the economy, and you don't know how hard they're slamming on the brakes?
Yeah, I think it means you got to be ready to pull the ripcord and go a little bit more defensive if everything deteriorates. But for now, with the Fed looking to slow and pause, we are cautiously optimistic. We do need to see what plays out with the banking contagion right now. And I think there's a little bit of fear that there might be this second wave coming. Remember, even with Yellen changing her remarks today and coming out saying, yes, we're going to look and make sure depositors are secure, being a depositor of a bank and being an equity or a bondholder in the bank are two different things. So we are looking and saying, hey, there might be risks in some of these regional financials. There's maybe a reason they're selling off and the bond markets and spreads are blowing out on them. But we think the rest of the market remains attractive, especially growth and tech, that we think that'll run. They're going to get some support from the Fed. The Fed, we would agree that with Phil that it looks to pause. So we think we're cautiously optimistic. However, it does seem like we are going to end up in a little bit of a crash. I do not think a soft landing with what's happening with banks, with what's happening with tightening. I think that's going to end up with the wheels on the bus come falling off in the second half.
What determines, Phil, whether that recession is brief or long and painful?
Yeah, so the Fed left the options open yesterday, and they said additional firming may be needed. They took the number off of their tightening. What determines the recession is going to be how much does credit lending and the deterioration in credit lending lead to a increase in financial conditions. So that has yet to be determined. So how much GDP is coming off when we don't have that much GDP to spare, right? Because we're so close to zero in the back half of the year.
So when it's harder to get a mortgage, when it's harder to get a credit card, when it's harder to get credit, when it's harder for small businesses to get that capital, how much does that jump?
How much does that take off of GDP first? But second, the up in quality trade is still okay. So Apple doesn't need to tap into a regional bank, right? So there's an up in quality trade of companies with free cash flow that's really important in both stocks and bonds. Investment grade corporate credit, we have a record allocation there. 25% of our fund is in investment grade corporate bonds. Not the most glamorous trade in the world, but something to take advantage of high quality that makes a lot of sense right now.
Okay, but Victoria, those high quality names, Apple, for example, pretty richly valued here. One could argue that it's already built in the idea that they're going to win. Where is their opportunity? What sort of out of position? What perhaps were investors betting against or thinking was going to lose that now, you know, you might take another look at?
The one I really don't understand why it's selling off is Charles Schwab. Their CEO came out today saying we could have 100% run on deposits and we still don't have to sell securities. They're actually gaining money. They're having it come into their money market, which they make money on. They're more diversified than a regional bank. So the reason they're getting hit, to me, I don't really understand because they have $100 million in liquidity. They came out today saying we don't have to sell that. We could lose all our deposits and we're still okay. Yet the stock very unfairly punished today. So for me, that's something I'm excited about. Names like like this, what we think is a quality name. They have a great business model. They had success in growing their different lines of business, and they have very deep relationships. And to me, it's a confusing mismatch, and I'm not sure what the market's seeing here and why it's unfairly punishing Schwab.